G'day everyone, welcome to this roundup for Australian and global stock markets. And it was not a lot of movement last week. The American market, as you'll see in a minute, is really poised for a breakout. And the most likely eventuality, of course, is that it be to the upside, but I'm not. My mind is not closed to the fact that it could go the other way. But I think the overwhelming odds certainly point to the upside. But the movement has been extremely tight. So let's get on and have a look at the action for the last week. In America, the S&P managed to gain 4 points. I think it was 6 points the week before, so incredibly tight ranges. I haven't seen this tightness in trading ranges across a day or a week for many, many years in America. So we've got this really tight calling pattern going on, and I can tell you that a volatility breakout, so a significant increase in the VIX index, is absolutely inevitable. It has to happen. Now, a breakout can occur in either direction, either up or down, but if you look at the pattern and if you look at the fundamentals, then overwhelmingly, I think the breakout is likely to be to the upside. Now, sure, there are headwinds in the American economy, but there is still some outstanding value in certain pockets. And most importantly, those stocks are receiving broker upgrades after the latest earnings season. And in America, it's the upgrades by brokers with their forward estimates that really does drive stock prices. Now, that works both ways. It means some stocks are expensive and are going to become more expensive, but it also means that the real good value stocks are also likely to move higher as well. So still some very attractive pockets in America. By comparison, however, the Australian index was down by 70 points on the week, and that was after two really big falls the previous 2 weeks. I think we were down 300 points the previous 2 weeks. We had another 70 last week, and it makes it 6.5% in 3 weeks from the top, compared to the American market, which is actually up by nearly 1%. So the difference between Australian stocks and American stocks is just absolutely chalk and cheese. It's what I've been talking about all year, and why I've been so strong in my my recommendations to have exposure overseas. So a lot of people finally jumping on the bandwagon. We've been there for well over a year. And I think the penny's starting to drop with a lot more people. So it's really the high yield trade, the banks and the other high yielding stocks which had driven the Australian market up for so long. And now that high yield trade, the money from overseas that's coming into those high yield stocks is now going back the other way. And it's just demonstrating how narrow our market is. It really is incredibly narrow. And considering that it's also only 2% of the global scene, the fact that so many people are totally reliant on the performance of the Australian market, that it really is a very, very high risk exercise to my mind. So the problem that we've got here in Australia as well is that as we've got these high level of stocks that are really have got a lot more downside potential than they have upside potential. But the great growth stocks, and we have got some, we've got some fantastic businesses, not that many, but some great global businesses. But they're fully too overvalued and have been for several years. So that really compounds the problem in Australia. So let's have a look at those couple of charts. We'll start first of all with the S&P index. This is the monthly chart, and it's going back to 1997 on the left-hand side. So you're looking there at about 18 years of trading history in America. You can see the two big peaks. This first one here in 2000, which of course led into the tech wreck, and the US market dropped from around 1550, dropped down to 800, so it lost about half its value. Then it happened again in 2008, which was an exact double top, and we lost about 60% that time through the GFC. But since then, you can see it's It's just been an extraordinary bull market, and also extraordinary in the sense that no one really believes it. You know, this is the most hated and skeptical bull market in history. People have been negative and trying to poke holes in it from the start. And despite this amazing run that we've seen, particularly in the last 3 years, 3 or 4 years since the last big dip in 2011, you know, there's still a lot of people who aren't on board this. We're not near a top, I can tell you, because tops form because most of the money is in the market, and most of the money is in the market when people are really confident, and that's just not the case. You know, people are still finding reasons not to be invested in the American market. This is the S&P index on the daily chart. So you can see we've got this really tight coiling pattern. You can see these dotted lines, which are the Bollinger Bands. You can see how wide they were back here. You can see they're quite narrow here at the moment. They've really pinched in, and it won't be too long before we get an explosion, and I believe that will be to the upside, because we do have, whilst it's caught in a big range and has been for some time, we've still got an upward bias. We're still forming higher lows all the way through here. So if you go back to December of last year, so for the last 6 months, it's been higher lows all the way through. So I think the move will be to the upside. Just looking at the Australian market, this is our index. Of course, we know we're near our highs that were formed back in 2008, late 2007. We're still struggling. We managed to break out above this 5,600 level. We've now retraced back to that level, and I still think there is some risk to the downside because of the big picture of what's happening with the high yield stocks. Now, I thought I'd just make mention of what I'm doing with my own personal superannuation money, because I do get questions about this. I've had a heavy bias to the US for quite some period of time. Unlike most investors tend to be either growth orientated, or they tend to be value orientated, and that's their primary aim. Or some investors might be what's called momentum orientated. In other words, they just go with what is going up, whether it's whether it's a good stock or whether it's good value or not. I really demand all three. So I'm extremely picky and particular about what I do. And in the areas that I'm working in America, I'm really quite comfortable. 75% of my overall funds in my super fund are in America, and I can tell you that I sleep extremely well at night with those businesses that I own, and I don't really regard them as stocks. I regard them as, terrific businesses that I've acquired for a value price, and the latest earnings seasons just really reinforced how well those businesses are going. Now, my Aussie portfolio only represents about a quarter of the overall, and even within that portfolio, I'm currently sitting about 60% cash. So I'm actually quite wary about the Australian market, and I don't hold many investments in Australia, and the ones I do are ones that I've got a high degree of confidence in. But look, I recognise that they're not particularly great value, so that makes me a little bit wary. Now, just touching on the Australian dollar, it's critical, I believe, because obviously if you're going to have funds in America, you want to have a view on the currency as well. Certainly, if the currency was likely to go up 10 or 20%, then that would be an issue. But I don't believe that is the case. I think the Aussie dollar, this is probably the little bit of a blip upwards we had to have. It's probably topped out. The fundamentals would dictate the Aussie dollar going lower. All the major players want it lower. The Reserve Bank, business, consumers, really everyone wants it lower. And I believe that the interest rate differential, so what I mean by that is I think our interest rates are going to have to go down, and I believe interest rates in America at some point will start to go up. So the difference in bond rates and cash rates between the countries will narrow, and that will make the Australian dollar less attractive. So my outlook remains low 70 cent range this year at least, and possibly down into the 60s, depending on what happens to commodities. And I do expect that we'll get at least one more rate cut this year and possibly two. So we could see, we're already at historic lows for the cash rate, but we could see the Australian cash rate at 1.5 before the end of the year. I'll just show you a chart of, we'll look at the US dollar index because that's interesting, and we've been looking at that quite a bit over the last year or so. We had a critical level here at 92.2. So if we just pan back and review why that is the case. So picking up these really important lows going back to 1998, all these important lows through here, these important peaks. November 2005 was the last one. So that was an area of really great strength or support and resistance. Now you can see we've pulled back. We didn't quite get there before the US dollar turned around and started going up again. Whether it'll have another little go to the downside, I don't know. I'm not going to try and predict currencies in the short term, but in the medium term, I'm comfortable that the US dollar is going up, and that we'll look at the Australian dollar. That's the Aussie dollar. So we peaked out at about $1.11. That occurred in July of 2011, which corresponds, of course, with the peak in the commodities boom. And then we leveled out around $105, $1.05 through till about 2 years ago. And then we started to slide. Once it became apparent that commodity prices were coming off the boil, the Australian dollar started to crack. And we then dropped into another range in the mid-90s, and now we've dropped down to this lower level. So you can see of late there's just been a bit of a blip up, but all it's done is bring the Australian dollar back up to that 150-day moving average, which is really controlling the downtrend. So as I said, short term, I won't make any claims to know where it's going, but I feel comfortable that in the medium to longer term, the Australian dollar is heading lower. Just quickly on commodities, gold was down $20 for the week. It's just continuing to grind out a big base. Further downside is possible. I think $1,000 is possible. It's probably not a high probability, but it's the gold market. It's just not a good reward for risk. So as I've been saying for weeks now, just stay clear of the precious metals market for the time being. Now copper, these back to $2.80, and that's really reflective of the fact the US dollar has turned around a bit. Crude oil, it was steady, just West Texas crude, just under $60, but I do expect lower yet because the supply and demand situation for oil just hasn't changed. So it's hard to see why there'd be strength in the oil market. And this is the spot copper chart. So overall, my strategic approach: local stocks, extreme caution, essential to hold high levels of cash, in my view, in the Australian market, and the odds favour a US index breakout. There are great stocks in select sectors. That has been confirmed by the recent earnings season, which was outstanding for those stocks, and they will continue to perform. They're getting broker upgrades, so I'd expect to see the share prices continuing to move. And certainly in the latter half of last week, the stocks of greatest interest to me had a really good finish to the week, despite the fact that the index was flat. However, I do recognise that there are a lot of stocks in America that are either not good stocks, or they're not great value, and so I would expect that there'll be a high proportion of stocks in America won't perform, but there certainly will be some outstanding performers. So for anyone who's not a member, of course, all the members are in fairly regular communication with me. For anyone who's not a member and would like to talk to me about how I might assist you, then there's my website and email details. That's it for this week. Cheers.